one with the husband, a refinance, and they were looking at the 1003, and she looked over and she goes, "What's that $670 payment to Harley Davidson?" He goes, "Oh, that's the bike I have." She goes, "But you bought that from Bill for $8,000 cash." He goes, "Oh,
Not exactly.
not exactly."
Okay, I've started.
Okay, good.
Right.
Now I've got it, showing you guys, Randy, as well as the screen.
Okay.
Okay. And you have your clicker to advance?
I have my clicker. And you have us here till 2:30?
Ah, yes, and here's
Pizza.
pizza. Come in and to the right. Back there. Yeah, back counter. Awesome.
That was pretty good timing.
Something like that, they need to sign? No, you're good, you're on time. No need?
I need the receipt.
Oh, we do need to receive this. Go ahead.
I go get plates and stuff.
Oh, okay.
Thank you.
All right, well, we will go ahead and get started then because I want to be respectful of everybody's time. And I do have a lot to cover. So just so I know who I'm talking to, how many of you all are brand new in the business?
Everyone?
It's 100%. Okay. Well, as you may have heard just a moment ago, I was once in your seat. I was a real estate agent for 12 years, and I was brand new in the business.
as well.
Okay.
Please do.
All right. So I can sympathize with your position,
Yes.
and I can also share in the excitement and the thrill that you guys are going through, being newly licensed and engaging in this new endeavor. Okay. I encourage you to take advantage of everything this office has to offer. Again, I've been in this business all my life on one end or the other, and I've never been in an office that offers as much support, as much expertise, and as many tools as you all have at your disposal. It was totally different than when I was coming on board. So I encourage you guys to really plug yourselves in, listen to everybody that's trying to help you, and take advantage of the tools that are here. Okay? So one of the tools that you have at your disposal, or one of the assets that you have at your disposal, is us. My name's Randy Lipp. I am with Certainty Home Loans. I do run the team that is here.
Randy? No, point it where I put your stick. Okay, I may have messed it up.
We good?
This is casual. Y'all jump up, go make yourself a plate with pizza.
Yeah, get come.
L-I-P-P?
Yep, LIPP. Oop.
Let me, hold on. Okay, now try it.
Got it. Okay. So there are 5 people on the team. We have 3 of us stationed out of here. We also have the Buckhead Keller Williams office. And we're here to help you guys. We're here to make your lives easier. We're here to be part of your team. Because what you need going out on this new endeavor is you need a team.
Yes.
You need a home inspector. You need a lender. You need, a closing attorney. You need a termite guy. You need all of these people on your team that are at your beck and call. Okay? Now, this is Paul. He's on the team. The guy in the middle, Matt, will be here in a few minutes. He's on the team. And y'all are welcome to use any of us at any one time, depending on who you gel with best or who you think your client's going to gel with best. Okay? So just because we're a team, though, we don't pool our money and share it. We all work on commission just like you guys do. Okay? So we're all going to be after your business. All right? So we want to be part of your team and help you be successful. So let's talk about what we do. We pre-qualify, pre-approve your buyer clients. Now, why is that important? Well, very simply, I didn't do that when I started. I worked with a buyer for 4 weeks, drove him all around town, only to find out he didn't qualify. Okay? Lesson learned the hard way. I would advise you guys not to learn that same lesson like I did. Get your prospects not only pre-qualified but pre-approved. Does anybody know what the difference is when we talk about pre-qualified to pre-approved? Probably not. Okay. Pre-qualified, a lot of lenders will pre-qualify somebody in 30 seconds, and they'll just talk to Teresa over the phone. Oh, tell me about you. Do you have good credit? Yeah, I've got good credit. Do you have, how much do you make? Well, I make, $120,000 a year. Okay, great. Well, then you're pre-qualified for, a $300,000 home. They call that a pre-qualification. I don't. When I'm talking to Teresa, I'm going to ask her, okay, you say you've got good credit. Let's check it and see. Okay? Because what we need to do is we need to check your credit, make sure that everything's in order, that nobody's been using your credit without your knowledge. Plus, every time we pull credit, we have a tool that pops up where we can give you advice on how to improve your credit score. And we'll get into that in detail a little bit later on. It's my favorite part of this session is talking about credit, because credit drives our business. It determines a lot of things. It determines the loan program, the interest rate, whether you can do the deal you want to do or not. A lot of it's dependent upon credit. So very, very important. A pre-approval is a deeper dive. If I'm talking to Eva, did I pronounce that right? Not Ava, it's Eva, right? If I'm talking to Eva, now I've looked at her credit, that's a pre-qualification. Pre-approval is, now I'm going to look at her pay stubs, I'm going to look at her bank statement, I'm going to look at the other things that go into the loan, so I'm going to make sure that everything's done. So let me ask you this. Alan, if you're the listing agent, and you've got Teresa coming to you from Fly-By-Night Mortgage Company that's been pre-qualified, and Eva that's coming to you that's been pre-approved by Certainty Home Loans, they've both made the same offer. Which one are you likely to give more credence to?
The one that's been approved.
Right, the one that's been approved. Okay? So you guys working as buyer agents, you want to do the best thing for your clients. Don't let them just be pre-qualified and, I don't want to ask them too much. No, you've got to be protective, and you've got to put your client in the best position. You want them to be pre-approved. Okay? Now, we hope it's with us, but even if it's not, make sure they get pre-approved. All right? So, let's talk about the very beginning. What happens? Marche, you're meeting with a client for the very first time. You're doing your buyer consultation. You guys have been through this Ignite class. You've heard a lot of people talk about it. I'm sure that other people have told you to get them pre-approved. Okay? So you're talking to a client. You say, well, I really want to work with you. Let's get going. I need for you to get pre-approved with my lender that I work with. And what's one of the things they might come back and say? They might come back and say, oh, I've already talked to Wells Fargo a few months ago. I'm fine. Let's just keep going. You going to accept that? Okay? Or they might say, you know what? My brother's sister's cousin's niece is in the business. I've already talked to them, and I'm fine. Let's just keep going. So you're going to come back and say, well, I understand that, and you know what? You can work with anybody you want to once we're under contract, but right now, while we're getting going and I'm showing you homes, I want to make sure that everything's okay. So I need, and I'd use that word, I need you to get pre-approved with my guys. All right? You have to be a little direct and a little forceful here. I need you to do this. All right? What's one of their other objections? the biggest objection I hear all the time is, what's that? Time is one.
They don't want to pay the money for it.
It doesn't cost anything, so
Oh,
that's
okay.
not an objection.
Okay.
Okay? The biggest objection we hear is, I don't want you looking at my credit. I don't want you looking at my credit right now because I heard it costs me points every time you pull my credit. Is this a hard pull or a soft pull? Well, I mean, it's a hard pull. We're going to look at your credit. But you know what? How else are you going to get pre-qualified and pre-approved if we don't look at your credit? I'm sorry, I love you, but I'm not going to take your word for what your credit looks like. All right? We need to see it. And the bottom line is, number one, yeah, it does cost their score a couple of points after we pull it.
Really?
All right? Sure, it's an inquiry. It's going to cost them a couple of points. They're going to get those points back in a couple of months. Also, if another lender's already pulled it, because of the in the past 30 days, because of the FACT Act, it's not going to affect their credit score if we pull it behind them. Important information to know for you guys. Plus, every time we pull it, it's given us a roadmap of what we can do to help you improve your score. So we look at this as a very, very positive thing. And again, we're going to get in depth a little bit later on. But it's important for you guys to know that part of that pre-qualification, pre-approval process is looking at their credit. It's a critical part, and do it sooner rather than later. Don't say, well, okay, I'll go out and show you property for a couple of weeks and then we'll do it. Bad move. Do it up front. Very important. Okay? All right, what's one of their other objections might be if you're talking to somebody for the first time, I don't have enough money. A lot of people think they need 20% down to go buy a house, and you used to. You know, when mortgages first started existing, coming into existence, you had to have 20% down. Well, you don't have to do that anymore. Okay? Because now, did she just win something?
Her new business card.
Oh, cool. That is victory.
Printer, right.
All right. So we can help them plan for their down payment. Anybody know what the minimum down payment right now is?
5%. 0. Veterans, it's
You guys are all right.
Yeah.
Okay? Because it depends on the loan program. We have a program right now that actually it's 101% financing. So there's no down payment. Now, some of those programs are harder to qualify, okay? The window gets very small that they have to fit through when you talk about down payment assistance and low money down. But if you're a qualified veteran, it's no money down. If you're buying a HUD home, it's $100 down. If you're doing a conventional loan, it's 3% down. If you're doing an FHA loan, it's 3.5% down. So you guys don't have to know all this, but what you need to know is that as your competent lender partner, we do know it. And we're going to counsel your prospect so they know exactly what they can expect and what they can do and what they can't do. All right? Loan programs. We've got a lot of different loan programs, conventional, government, jumbo, FHA, VA, USDA, all of these things. You guys will become acquainted with these as we go along. Right now, it's just important for you to know that we've got just about every loan program there is. Just about. Not all. We don't have 100%. If they're looking to borrow money to build a home, a construction loan, we don't have that. Besides that, we've got just about everything else. Okay? So, like I said, on a conventional loan now, you've got 100% financing available. Actually, 101. VA, 100%, FHA, and jumbo. That's what I was just talking about. This is an interactive class. Any questions on that as we go along? I've been doing a lot of talking. I'll come up for air here for just a second.
There's some products that we don't have that still come to us. One of the agents came to me about a loan, and he's going through another small bank, and now the guy's going to be buying a bunch of investment properties. on a product I've never heard of. So we always have our different connections out there to even help you with the out of the box loan, so.
And we will talk about some investment loans that we have that are phenomenal. And we'll talk about, yes, sir.
What is the name of the act that states that it wouldn't affect your credit score?
FACT, F-A-C-T, FACT Act. Don't ask me what it stands for.
Fair and.
The F stands for fair, the C stands for credit. Other than that, I'm not sure. All right, here we have the loan limits. Now, this is kind of important because if you've got a 700, if I've pre-qualified your borrower and they have to go FHA, and there's some compelling reasons why they might have to go FHA, and they want to buy a $500,000 loan, they're going to have a little bit of a problem. Okay? Now you can do it. They just have to come up with $120,500 down. But if they want to do that, they can do it. USDA. Anybody heard of USDA? Mm-hmm. Yeah. When you buy your steak at Publix, it's stamped by the USDA. It's the same people, actually, that do these loans. It's for rural development.
Farm areas.
It's a lot of people think it's farm areas. It's just rural. I live up in Cumming. Does anybody know where that is?
Yeah.
Far.
Sure.
Yeah, it's far. Okay, but on the north side of Cumming, you can do USDA loans on the north side of Forsyth County. So we have a lot of subdivisions up there where the whole subdivision's no money down. Okay, because it's developed to promote rural growth. All right. But USDA is geographic specific. In other words, you, or you could get a USDA loan. It doesn't matter who you are.
But not in the heart of Sandy Springs.
Right. But you can't do it here in Dunwoody or Sandy Springs. Now, if you're going to do an FHA loan, anybody heard of FHA? Mm-hmm. Right. Let's, real quick, let's talk about some myths of FHA. Biggest myth, you have to be a first-time home buyer. Not true.
Oh, okay.
Okay? Not true. All right? Second myth, you have to be low income. Not true. You could make $1 million and still get an FHA loan. You make $1 million a year, still get an FHA loan. Another myth, you have to have bad credit. Not true. You can have perfect credit, still get an FHA loan. Another myth, you have to have little to no money in the bank. Not true. So Randy, you've told us all this stuff that's not true about FHA. Why do people go with an FHA loan versus a conventional loan? When a conventional, you can go up to 484, FHA, you can only go to 379. What's one reason, Paulie, they might go with an FHA loan?
Higher debt to income ratios.
Debt to income ratio is one of the key things we look at when we're figuring out if you can qualify or not. We have certain ratios. A conventional loan is very strict, very tight at 45% debt to income ratio. Again, you don't need to know these numbers. FHA, I've gotten one at 56, 57% approved. So they're much more liberal. Another reason, foreclosures and bankruptcies and short sales. FHA is much more forgiving on those. They have a much shorter time period of recovery than a conventional loan. Another reason why somebody might go FHA is they have mediocre credit. FHA is not very sensitive to credit. Now you still have to have decent credit, but their rates are much better in the mediocre credit range than a conventional loan. Like if you've got a 660 score on an FHA, you might get an interest rate of 4% today, and on a conventional loan, it might be 5%. Okay?
And higher PMI.
Right. And higher mortgage insurance. Now, So all that sounds great, doesn't it? Sounds like everybody should go FHA. You know what the other thing is? FHA loans are assumable. If you get an FHA loan at 4% today, 10 years from now, rates might be 6-7%, who knows? You could sell your home, they could assume your 4% rate on your mortgage.
But
It's a
you
selling
can't-
point.
But you can't sell within the first 2 years or something, or first amount of
No,
years?
you can't.
Oh, okay.
Here's the negative on FHA. The mortgage insurance you'll pay twice. You pay up front and you pay monthly. And that monthly mortgage insurance will never go away over the life of the loan. On a conventional loan, anybody ever heard, 20% down is kind of a magic number? If you put 20% down on a conventional loan, you don't pay mortgage insurance. Mortgage insurance also goes by MI, PMI, MIP, all of those, they all mean the same thing. It's all mortgage insurance. Okay? Mortgage insurance gets a bad rap because everybody thinks it's a real nasty thing. But it's very important because it helps people that don't have 20%. It helps them buy a home, which is going to be good for you guys. Okay? Because not everybody has 20% to put down. So on a conventional loan, once you reach that 80% loan to value threshold, in other words, you got 20% equity, if you have mortgage insurance, it goes away. Whereas FHA, it never goes away. Now, that's not necessarily a bad thing because anybody know what the average time we keep our homes is?
Less than 2 years.
Nah, it's more than that.
At least 5 years?
More than that. It's in that 4 to 5 range.
5.
Actually, it's gotten a little bit more than that in recent years. But that's not enough time for the mortgage insurance to go away anyhow. Okay? So it's really maybe not a bad thing. Excuse me. That was the boss.
You knew it was ringing before it was ringing.
Yeah. All right. So let's talk about credit. Anything over 740, you're golden. Okay? That's kind of like the threshold. If you're a 740 or over, you're going to get the best of the best. And on a conventional loan, you can go all the way down to 620, but what's going to happen? You're going to get killed on the rate. You're just going to get killed on the rate. Whereas with an FHA, anything over 680 is good. You're going to get the same as at a 680 as you would at an 800. Okay? So we'll do FHA loans all the way down to a 580 credit score, but just being very transparent, there's a lot of restrictions if you're down in that range. And you know what? Generally speaking, there's a reason why, if somebody has a 580 score, there's usually a reason, and they're probably not going to get financed. Now, sometimes I've done 610, 615 credit score loans, usually have a good shot at getting through, but whatever. Jumbo loans, anybody know when we talk about a jumbo, what that means? I had it up there just a second ago.
Well, it's a big balloon payment, right?
No, but that's a valid response because that's what a lot of people think. What a jumbo loan means, Polly?
Loan amount over $484,350. So if your loan amount's $484,351, that's a jumbo loan.
Right. Okay. Now what that means is that Fannie Mae and Freddie Mac aren't going to guarantee that loan. They're not going to take that loan. So what happens? Well, it goes to investors. Okay, investors that pool their money either usually at a bank. In other words, we have maybe 20 different investors that we go to for jumbo loans, and they all have different requirements. But the one requirement they do have is generally they want to make sure if you're borrowing that much money, they want to make sure that you're a good candidate. So they're going to look a little closer at credit. They're going to look a little closer at income and debt ratios. They're going to look a little closer at your assets. Okay? So it's a little bit more paperwork, shall we say, to get through with that. All right, we talked about credit issues. Conventional loans, if you have a bankruptcy, it takes 4 years to get rid of that before they're not going to consider it. For FHA, it's only 2. Remember I told you FHA was a lot more liberal when it comes to credit issues. Guys, there's still pizza in the back. If you haven't gotten any, make sure you get some. Foreclosure, same way. FHA is only 3 years, conventional 7. So there's some compelling reasons why we might steer somebody to an FHA loan, or suggest that this is the best way for them to go. All right?
Wait. Thank you.
All right. I love talking about credit. Again, what's the most important thing in loans is credit. I love talking about credit. So what's some of the common mistakes? Anybody ever, if you've got good credit, you've got a couple of credit cards with balances, you get these offers all the time. Hey, switch over to XYZ card, transfer all of your balances over to this card, we'll give you 0% for the next 100 years,
No way.
and close out the other cards.
That's not good.
It's like worse than death.
That's not
Because, one, you're opening up a new card, ding. 2,
your history.
you now have a large balance on that card, ding. 3, if you close out these other cards that you had a good track record with,
Ding, ding, ding.
It stops reporting.
You-
it stops reporting. Okay? So that's one of the worst things you could do from a lending perspective. Now, if you don't need a mortgage and you don't care about your credit score, you're not planning on making a major purchase, maybe it's a good thing. But I would still never close out those old cards. Okay? How does credit work? I'll get to that in a minute. I see it's not quite yet. I just talked about closing accounts. I love this guy, all right? And if anybody here Dave Ramsey fans, okay, he's great, but his advice isn't always the best thing if you're trying to get a loan, all right? Because he likes for you to have no debt.
Right.
And eat rice and beans.
He likes for you to have no debt. As a lender, I don't want you to have a lot of debt, but I want to be able to look at your credit report and I want to be able to tell that you can manage your debt properly. And if there's nothing to report, I can't tell that. All right? I want to see that you've had a car payment and you've made the payments on time. I want to see that you've had a credit card and you've made your payments on time. I just don't want to see a bunch of zeros there where you got no debt. Okay? And I mean, that's just the cold hard truth. When we're trying to get a loan, we want to see that you've got a history of properly managing your debt. All right? Another common credit mistake is when I give you the phone call to say, hey, congratulations, your loan is clear to close. We close in 2 weeks. You hang up the phone and you go, all right, honey, let's go down to Rooms to Go and let's buy that new house full of furniture. Huge mistake. When I tell you your loan's clear to close, that doesn't give you carte blanche to go start running stuff up. We monitor as your lender, you're my prospect, you're my buyer, we monitor your credit right up to the closing table. If you take out any new debt, we got to redo your loan. Has that happened? Yes. Yes. I've been at the closing table where we've discovered somebody bought a house full of furniture. We did not close that day. Not until they returned to Rooms to Go, canceled their contract, and we got it updated on the credit report, then we closed. Okay? Opening new accounts. Now, other than you will have to call the power company and they'll run your credit or something like that, no big deal. But don't go out and buy that new Ferrari. Wait until the day after we close, please. Even if you're co-signing another account, a lot of people don't understand, oh, I'm just a co-signer, it's not my account. If you're a co-signer, it's as much yours as the other guy. Yeah, and I run into it all the time where, oh yeah, I co-signed for my niece's car and she never made the payments, but that was her, that wasn't me. Yeah, guess what? It's on your credit report. Here's what our credit pulls look like. This be interesting stuff. Again, I love talking about credit. I've spent a lot of time on it. This was a real report. I blanked out the socials and everything. But it tells us when we pull this report for this person, it tells us what their score is, 625, and what their potential score is if they just do a few simple things. This is what I'm talking about. Look at the numbers here. That's how much we can improve their scores, and that's why we want to talk to your people early. Because if this person right here waited until they were under contract, they're in trouble. They could have got a lot better deal if they would have let us pre-approve them early. Okay?
It's the coolest tool. What I like about it, you got your consumers out there going, well, my brother, worked at Citibank and he said I could do this, this, and this. And he doesn't know. This is pretty much 98% accurate. Or better.
This is something that a lot of people don't have. And it's something that we really like. So then we go to the expert. They say, okay, it says you can do 107 points. What do I have to do? Well, it's going to cost you $3,326. That doesn't mean a fee. You pay us $3,326 and we'll raise your score. That's not what it means. It means you have to spend that money on some of your credit items strategically to get your score up. So we see, okay, here is the strategy. Now it lays it out in black and white. Look here. Pay down the balance to $216 on your Capital One account that ends in this. How specific is that?
Can you go back to the other page one more time? Thank you.
If you ask real nice, I might just email you this.
I will, please.
You make sure your business cards are up here, and I'll
Okay.
email it to you.
Awesome.
Okay. So we're able to tell your clients and our clients, our mutual clients, exactly what they need to do to raise their credit score. Why is it important? What's raising their credit score going to do?
It's gonna
Get
help
them
them
alone.
Better rate.
Yep. Better PMI.
Better rate, better mortgage insurance. It might make the difference between being able to buy this home or the home they really want. Okay? So it's better for you guys. It's better for them. All right, let's talk about income. Now, again, I'm not trying to teach you guys to be loan officers. I have enough competition. I don't need any more. I want you to be good real estate agents, not good loan officers. All right? But income, a lot of people say, oh, I'm self-employed, I can't get a home. You ever heard that? I'm self-employed, I'm going to have trouble getting a home.
Yeah,
well, guess what? Who in here is self-employed? Hello? Every one of us, all right? So it's not that you have trouble getting a home, it's that there's a little bit more paperwork to be done, okay? Especially if you're a business owner or one of those fields where they write everything off. Let's just choose an over-the-road truck driver, for instance. Okay, I get a call from Joe, and he's an over-the-road truck driver. He tells me he makes $120,000 a year. That's great, Joe. I can pre-qualify you at this amount, but I want to pre-approve you. Send me your tax returns. I get his tax returns. He writes off $95,000 of the. He does make $120,000. That's the top number on his return. But then his expenses, he writes off $95,000. He got gas, he's got food, he's got wear and tear, depreciation, he's got this and that and the other. And by the time it's done, I've got $25,000 left to work with. Okay? So, yeah, he makes $120,000, but he doesn't keep $120,000. So, self-employed's a little bit more difficult. So especially if you're working with a self-employed person, get them to us early. We want you to get everybody to us early, but especially those self-employed people. Because we got to peel that onion back and figure out exactly what we can do and what we can't do. All right? But a lot of this people don't normally think of as income, and we can count it as income. If they're getting alimony, child support, disability, Social Security, they're working part-time, we can count that as income. There are restrictions on it. In other words, if your person you're working with doesn't even work, they're getting child support. Can we count that? Can we not? We can count it as long as there's 3 years left on the support. And we'll probably have to look at birth certificates of the kids, okay, and get the divorce papers and stuff like that. But yeah, we can count it. If they're just working part-time, they have to have been there for 2 years, but we can count it, okay? So there's a lot of different restrictions, but what's important for you guys to know is that all of this can be counted. How about unemployment income? Yeah, don't try it. No, let's don't go there. All right. How about, this is a big one. This becomes a cultural thing. There's a lot of, we have a very diverse community, okay? A lot of different cultures. There are certain cultures that don't like banking at traditional banks, okay? They almost do cash share. And there are certain people that like to keep money in a safe at their house, okay? Well, after 9/11, the government cracked down on lenders and said, y'all need to make sure you know where the money's coming from before you lend on somebody, their down payment for a house. Because we don't want them to be a drug dealer, money launderer, or terrorist. So if there's deposits going into their account, we've got to track them. We've got to know where those deposits came from for the last couple months. Not the last couple of years, just the last couple months. If they've got green cash in the bank, in the safe, we don't know where that green cash came from. So we have to track it. So it's much more difficult. Another reason why we want to talk to your people early, because we can help them avoid those pitfalls. Now that doesn't mean that we're not going to finance somebody that's in a cash job. Billy Jim Bob that mows the yard, he works in a cash business. So he has very consistent deposits. So that's okay. Okay? That's okay. Dixie that does the pole dancing downtown, she cash business. Okay? But a very consistent deposits, so that's okay.
How far would you go back for someone that could make their deposits? Would you go back like a year? Or
No, 2 months.
Oh, 2 months.
Just 2 months.
Okay.
2 months. But if we see deposits coming in, why do people wait till I'm in the class? Oh, maybe they're calling me saying I can see you. If we see deposits coming into their account from someplace else, then we're going to have to follow that thread back a little further.
Oh, okay.
So I say 2 months. It could go back even further if there's a reason for us to go look. We don't want a reason, okay?
No.
So if the money's been sitting there for 2 months, that's perfect. So if they've got green cash in the safe, get it out, get it in the bank, let it sit there for 2 months, and then we'll be okay. Okay? All right. One thing a lot of people don't think about when you're talking to them, and they say, I don't have enough money for the down payment. 401k. How many of you knew that you could use 401k money for a down payment? How many of you are sitting there going with big eyes going,
I didn't know that.
wait a minute, if I take money out of my 401k, they're going to penalize the heck out of me.
If you're buying a home,
Yes, they will.
they will, even if you're purchasing a home?
Yes, they will. Let me tell you how to get away.
Very few, will they not penalize, and that has to be
They will. However,
paperwork to death.
90% of the people that have 401ks can borrow against their 401k. If you got $50,000 in a 401k and you need 20 grand to buy the house, if you just withdraw that 20 grand, they're going to penalize the heck out of you.
But if you roll
Unless
it
you're as
over-
old as I am, then they won't.
But if you
But-
roll it over,
Me
they
too.
won't.
But if you borrow it, they'll loan it to you at a very low interest rate,
You just pay it yourself back.
'Cause
and
they
you
can't
pay yourself back.
Yeah.
And you
With
can
interest.
use that 20,000 for your down payment. And guess what? That payment on the payback, we don't even have to count it as a debt because you're borrowing your own money.
So how do you pay it back?
Every
You have
2
to be
weeks.
employed
Yeah.
with that same employer. In other words, if it's a rollover 401k,
Yeah.
if it's from an employer that you had previously, you can't do it.
Okay.
It's got to be with somebody that you're employed with
I
now
see.
because they have to be able to take it out of your paycheck.
Gotcha.
Okay? But it's a great way for your prospects,
Yeah.
the people you're working with.
Yeah.
They say, "Hey, I've been on my, I don't have the 20,000 I need. What do you got in your 4? Oh, I got 100,000 in my 401k, but I can't touch it." Well, you might be able to.
Gotcha.
Okay? So we're planting some seeds for
Yeah,
you
that's
guys.
interesting.
All right? Gift funds from a relative. Hey, I'm getting a $20,000 bonus, but I'm not going to get it for 6 months. But I want to buy the house now. Well, then why don't you get a gift from Aunt Ethel for 20,000, and whatever you do 6 months from now is up to you. Okay? You get a gift from a relative. Very easy way to go. Questions on this? Okay? Yeah. A lot of people ask about closing costs. How much are closing costs? 1%, 2%, 3%, 4%?
It's usually 3%? No.
3% is what a lot of people use. So I developed this chart because it depends on what your loan amount is. You know why? An appraisal is, let's just say, $500. Well, if you're buying a $50,000 home, $500, that's 1% right there just for the appraisal. But if you're buying a $500,000 home, that percentage is a lot different.
Yeah.
Attorney's fees, they're $795. If you're buying a $50,000 home, that's 1.5%. If you're buying a $500,000 home, it's not that much. So it varies as to what the price of the home is.
Gotcha.
Okay? So it's a little bit of a curve there. So 3% is spot on if you're buying a $140,000 home.
Gotcha.
Make sense?
Makes sense.
Okay. We manufacture just about everything. What we don't, we even do that now, don't we?
What manufacturer home?
What-
Manufacturing homes. Just can't.
What don't we manufacture? What don't we finance? We don't
Condotels.
condotels. We don't finance.
Stay away from.
What's a condotel?
Condotel is like a
Like a hotel?
condominium.
Like an Airbnb? Wait, no, that's different.
Well,
When you go
it's-
in, there's like a desk you have to check into.
Gotcha.
It's like a hotel, but they're individually owned units.
Gotcha.
It's called
Apartments
condotel.
converted to condos. Those
Okay.
are tough until they're well established in the future.
Right.
Okay.
Log homes we finance because I just closed on one of those recently. So we finance just about everything.
We will not finance a working farm.
Nope. Renovation loans, which is one of our big niches that you won't find with a lot of other lenders.
Nope.
Especially at this time, inventory's tight out there. So if you're working with a borrower that has a very specific home in mind, and in a very specific neighborhood in mind, and that home it doesn't exist, then you can go into that neighborhood, find out a home that's already there, and show them how to make it their dream home. Because we will finance the renovations into the purchase loan. Let me paint it a different picture. You're going to buy a $200,000 home. You put 10% down. That's how much? $20,000, right? After you move in, I want to do this, this, and this, and this, and this to the home. I want to finish the basement. I want to do remodel the kitchen. It's going to cost me $40,000. So what's my finished acquisition cost? It's going to be the $20,000 down payment, and I'm going to spend $40,000 afterwards, right? Because I'm putting 10% down. On our loan, you could take the $200,000 that you're buying, the $40,000 that you're renovating, put them together. That's $240,000. Put 10% down of that. Now it's only costing me $24,000 out of my pocket instead of $60,000. Is there a benefit there? It's a wonderful, wonderful program, and one I encourage each and every one of you to grab one of us, go buy us a soda, a cup of coffee, and say, tell me about these renovation loans. Become an expert on that. It'll open all kinds of doors for you guys.
It's huge.
Okay? It is. I promise you. That renovation loan, and we have 5 of them, but if you learn those renovation loans, it could really make a huge difference in your business.
I was a buyer that may be possibly interested in that, but I'll talk about it. I'll talk
Right.
about
You
it
need to
later.
know how they work.
Mhm.
Okay?
Yeah.
Because there's 5 of them. They're all 5 different. Okay? Investment loans. Now we do have up to 85%, but I promise you, if you do 85% investment loan, it's ugly. Most investment loans are 20 to 25% down. We do have an investment loan. All right, everybody listen. We do have an investment loan where the buyer has to have decent credit, has to put 20% down, but doesn't even have to have a job.
Has to have a home.
Yeah, I said it. Okay? No income verified. They don't even have to tell us where they work or how much they make. The question will never be asked. And they can buy an investment property.
Only if they put 20% down.
Gotta have at least 20% down. And decent credit.
Whoa, now that's me. Say that one more time. That pizza.
It's called an investor cash flow loan.
Okay.
They have to have decent credit. I think they have to have at least a 700,
660 or higher.
660. Which
They
is
have to have a 12-month pay history on their primary residence.
right. They have to have a primary residence.
What if it's paid off already?
They have to have a primary residence with making a payment.
Payments, okay,
Okay.
okay, just
Okay.
clarifying,
Right.
payment history.
We have to verify the cash down payment. Source it. But they do not have to disclose any income. We don't look at tax returns. We don't look at pay stubs. We don't look at any of that. What we do is we do the appraisal on the property. And when we do the appraisal, they do a rental analysis. They tell us how much the property is going to rent for. They being the appraiser. The appraiser says this property will rent $1,500 a month. We compare that number with their new mortgage payment to buy that. As long as the rent covers the mortgage payment, they're approved.
Okay, cool, that's new.
Now, there's fewer criteria, so guess what's higher?
The interest.
The interest rate. Okay? All right. Now, on your contracts, wanted to go over a few areas. We've got just a few minutes left. Wanted to make sure you guys understand where to put certain things in your contracts. Okay? I think Stacy handed these out. You guys all have them in front of you? Okay. So under the conventional loan exhibit, this is where you'll get a pre-approval letter from us, and it'll tell you, or just ask us, how much of a down payment they're putting. That's right here. So they're gonna do they're gonna put 10% down, so they're gonna put 90 right here. Right? It's a 90% loan. or it could be a 95% loan, or it could be a 97% loan. Whatever they're putting down, you put right here. The term generally is going to be 30 years, and we'll list an interest rate on. We'll list the interest rate on our pre-approval letter. So you just take it right off the letter. With me so far? Rate type is generally going to be fixed. And the source of the loan is generally institutional. That's us. Okay? Now, down here, approved mortgage lenders. If you're working with the buyer and we've already pre-approved that, then you're going to put Certainty Home Loans, Paul Bryan, or Randy Lipp, or Matt Lipp. You're going to put our name right there and our phone number. Over here, finance contingency has to be filled in. You got a blank, you got to deal with the blanks. What's a normal finance contingency? Anybody know right now? Most of your peers are putting 21 days here. So if you're a listing agent and you get something in that says 60 days here for a finance contingency, there better be some red flags going up. Any questions on that? They're all different. There's 3 different forms. There's the conventional, the FHA, and the VA. We're going to look at all 3 real quick. This is the conventional. See what I got up here? Conventional. FHA is a little bit different.
Question, you mentioned, quick one, you mentioned 10% on the conventional.
Just arbitrary.
Just arbitrary? Okay.
Again, they could be putting 50% down.
Okay.
Or they could be putting 3% down. So, but you don't list the down payment, you list the percentage, you know, the what it would be called, the reciprocal, the residual, I don't know. You put the loan to value there. So if it's 3% down, you put 97%. Got me? Okay. FHA, a little bit different. Oh, I forgot to put something in there. All right, my bad. There's also a little bit further down here that didn't show. There's also an appraisal contingency on this form. Do you see that on there? On the conventional?
Let's go back.
That's number 11.
Number 11, yeah.
Right, appraisal contingency. I'm sorry, I forgot to put it up here. But you need to fill that in. What, generally speaking, people are putting 14 days, sometimes 21 days, just depends on your contract. But it takes us, normally it'll take the appraisers, depending on the time period, if it's busy or not busy, you know, somewhere around 8 to 10 days to get an appraisal in, unless you want to pay a rush fee. Or unless it's a condominium, which is a whole different topic. All right.
So which one is it? Is it like 8 to 10 days or 14 days?
14.
No, that's 8 to 10 is what it takes us to get them.
Okay.
Okay. 14 days is generally what I see there, sometimes even 21 days. And the reason for that is when you go through your due diligence period and you're doing a home inspection, sometimes it takes 4 or 5 days, 7 days, 10 days to get through your due diligence and negotiations after your binding, because you may find things wrong with the home. We don't want to order the appraisal until you're through that. And the reason for that is because when we order the appraisal, we make the buyer pay for it right then. Just like a home inspection. They got to pay for the appraisal up front. And they've already paid for a home inspection. I don't want them paying for an appraisal if the deal isn't going to work.
Makes sense.
So we don't want to spend their money without knowing that it's going forward.
Okay, that's a good deal.
Okay? So that's why you put a little extra time in that appraisal contingency. And just put an asterisk beside that. If it's a condominium, you want more time. Because there's a lot more involved. Let's talk about the FHA. So, how much down payment is FHA?
He's a little zero.
3.5%?
No. 3.5%.
3.5%.
So this number right here on your FHA, this number right here is what? Come on, you math wizards.
96.5.
There you go! 96.5. Kind of like a radio station. All right. And the term is 30 years, and the interest rate again will be on the letter. It's fixed and it's institutional. Now, look at your handout for your finance contingency. Again, generally speaking, it's 21 days. Again, all of that's negotiable. It's up to you in that specific contract. But on your FHA form, find the appraisal contingency. Remember, we found it on the conventional form. Where is it on the FHA form? Guys, look at me. It's a trick question.
I had a feeling when I didn't see it.
Wait, ask the question again.
I had a feeling when I didn't see it at all.
Find the appraisal contingency on the FHA form.
There's none on the FHA, right?
That's all right.
Gotcha.
Why is that? The FHA appraisal contingency goes right up to the day of closing. That's an FHA guideline. It's mandated by FHA. Now, is that a good thing or a bad thing? Depends on if you're working with a buyer or seller.
So it actually goes to the day of closing is when they do it?
It can. I mean, nobody drags it out that long. I mean, we're all in this world together trying to work with each other. I mean, you as soon as you get the appraisal, and then if it's low, you want to make sure the seller knows it. And an FHA appraisal stays with that property. If you guys back out of the deal, if the appraisal comes in low, you're buying it for 200, FHA appraisal comes in at 180, and everybody's saying, I'm not moving a budget an inch, and the deal dies. That $180,000 appraisal by FHA stays with that property for 6 months. If another FHA borrower comes in to buy that property, they have to use that same appraisal.
Do they have to pay for it? Do they have to pay for it?
Depends on the appraiser.
So the FHA actually sends their own appraiser out that works for them?
No, they're just,
Or they're contracted with them?
yeah, they're, the appraiser is FHA approved.
Okay.
So if it's a different appraiser, how do you know?
It's not a different appraiser.
It's always the same, okay.
Well, what do you mean?
Oh, you
I'm not
said
sure I understood.
The appraiser, the person that comes out to.
The first time,
Uh-huh.
On FHA?
right,
Yes. Is
that appraisal stays with the property.
it like in a file somewhere?
It's on file with FHA.
Oh, gotcha.
You have to get an FHA case number to buy the property, and you go through FHA to get it, and it's on file.
Okay. Good
So
to know.
you'll know. Well, any good selling agent, listing agent, I'm sorry, not selling, the listing agent will know that, and they won't accept an FHA offer, hopefully, because they'll already know. I can't.
Or they're gonna go to their seller and say, hey, if you do not negotiate, and our next buyers are FHA, they have to use this $180,000
The deal ain't gonna work.
and it ain't gonna work again. And that seller might go, maybe I need to put the pencil to this.
Or
To make it work.
they'll say, we're only going to take conventional or cash offers. Because if a conventional buyer comes in, they don't have to use that FHA appraisal. They can get a new appraisal.
But you just got rid of half your potential buyers,
Right.
or more.
You see that?
Yes.
Everybody understand that? Mortgage insurance premium. We're on FHA, number 12. FHA upfront percentage is listed right here. You can fill in it's 1.75. It's a key number. And it's always 12B is checked. It's always added to the loan amount. I don't think I've ever seen anybody pay it.
Never.
What percent, what was that again?
1.75%. That's 12 on the FHA financing contingency. And then you'll check B, added to the loan amount. Under 14, the tax service fees. Everybody wonders what those are. Tax service fees, make sure that property taxes are paid every year on the property. It's usually a nominal amount, somewhere between $75 and $100. So you can click either box depending on what you're asking for. Number 15 is just if you think there's going to be repairs that are going to be required, you just address it up front here and negotiate that at the time of your contract. All right, listen up. FHA appraisals are pickier than conventional appraisals. It's a fact of life. FHA will require things that conventional may or may not require, such as peeling paint. FHA will require that it's fixed. Conventional won't. If there's a very minor amount of wood rot someplace, FHA is going to require it be repaired. Conventional may or may not. If there's appliances missing, FHA is going to require they're there. Conventional may or may not. Depends on the appraiser. But what you need to know is that FHA appraisals are more critical than conventional. So if a home is in a state of disrepair and the seller cannot afford to do any repairs and your buyer can't afford to do any repairs, is that a home they should be negotiating on?
Mm-mm.
Wrong. Another trick question.
Yeah.
We have renovation loans.
Oh,
We have renovation loans.
that's
So don't let that stop you.
okay. Good question.
Okay?
Yeah, because I wouldn't have known that.
We have renovation loans. Don't let it stop you.
Mhm.
You're the problem solver.
Yes, absolutely.
That's what we do.
A lot of other of our competitors do not have renovation loans.
Right.
And I came from a big place, and they don't have it.
Here's on a VA. On a VA, the top part of it's pretty much the same. But what you want to know on the VA, if you go down to number 12, it's going to be B or C. Typically. C is going to be checked if the borrower is
10% or more.
disabled or receiving disability income from VA, then it's going to be C. And if not, it's going to be B. And again, as far as repairs and everything, VA is going to be along the same lines as FHA. They're going to be critical of things. And maybe even more so because they want to protect the veterans. So they're not going to let the veterans move into a house that's in a state of disrepair. Do we have a VA renovation loan? We do, but it's very small. They can't do many renovations.
Many. Rephrase that.
Yeah, whatever. What?
Many. You said many renovations. Rephrase that.
They can't do a lot of renovation work. They can do minor renovation work.
Pretty limited.
It's limited. There's a better word.
Thank you.
All right. We're way out of time. I think. We're going to 2:15 or 2:30?
I would say 2:30.
Oh, then we got plenty of time. All right. One of our pet peeves is when agents are writing amendments. All right. You're binding on the contract. Hey, congratulations, you got your buyer. The seller's agreed to all your terms. You're under contract, you're binding. Now comes due diligence, now comes your inspections, and now you're back negotiating again, right? So how do you do that? You write amendments. You don't write a whole new contract. You write amendments to your existing contract, okay? It's important for you to know how to write a good amendment. Number one, personal property. I'm a lender. I'm not going to lend you money for a big screen TV on a 30-year loan. It ain't going to last 30 years. I'm a lender. I'm not going to lend you money for the lawn furniture. I'm not going to lend you money for the lawnmower or the golf cart that's being left behind. I'm a lender. What do I lend on? I lend on real estate. Okay? Now, this is something we go back and forth on all the time. You're working for your borrower. The seller's agreed to leave the golf cart, the lawnmower, the big screen TV, and the lawn furniture. So you want to make sure that they get that, right? But I'm a lender. I don't want it in the contract. So the answer is put it on a separate bill of sale at zero value. That it's being left behind for the convenience of the seller. And it has zero value in this transaction. That'll work.
Personal property.
It's right. That'll work most of the time. But I promise you, if you put it in the main part of your contract and you've got a laundry list of 10 things, the lender's going to have a problem with it. What they generally don't have a problem with in the contract is, refrigerator,
Blinds.
yeah, blinds, ceiling fan, stuff like that. Don't have a problem with it. It's when you get to the big screen TVs and the lawn furniture and the golf cart and the riding lawnmower and all of that, the play set, that's a $2,000 play set out back. If the underwriters, what they want to do is they say, oh, well, all of these items are worth $5,000, so we're going to take that off the purchase price, and now we're only going to loan you 90% of what's left.
Oh.
So it ends up, it hurts your borrower because now they got to pay for all this stuff, cash.
But since you put it that way, I definitely remember that.
Yeah.
Gotcha.
All right. Number 2, this is kind of a big one.
Huge.
In your amendment, what we see sometimes is because of the home inspection, Article 1, Paragraph 3 says there's a hole in the roof, we want that fixed. And the agents will take the home inspection and reference every single page and paragraph, and they'll want all of these things fixed. Okay? Now, where it becomes a problem is if the seller starts this. All right, we'll do number 1, cross through number 2, cross through number 3, cross through number 4, we'll do number 5. Initial it, give it back. Well, now the things they've crossed through, my underwriter's seeing. My underwriter sees repair the mold in the basement. Nope, not going to do it. Cross through. Well, what do you think my underwriter's going to say when they see that? Yeah, they're going to say, yeah, you are going to do that or else we're not going to loan the money. Okay? Or they see, water stains in the master bedroom. Please have a licensed roofer inspect that. And they've crossed through it. Whew, big red flag. We're loaning money on a piece of real estate. That piece of real estate, we want it to be in decent condition and we want it to not be deteriorating. Now, if they've crossed through, the carpet stinks and we want it replaced, who cares? That's not going to hurt the property. But a hole in the roof will. Mold will. You know, how about a dangling, I've seen before, dangling wires out of the garage ceiling. You know, that's a safety hazard. You know, those things have got to be taken care of. Now, if you give a list, please repair this, please repair this, please repair this, and they say yes, great. I don't care. That's good, because we want that to happen. But we have a problem when it's crossed through and we can see things we shouldn't. Or even if it's not crossed through and they reference the home inspection. Because when you reference the home inspection, now the home inspection becomes part of the contract. Got me? If you're referencing the home inspection, it's part of the contract. Now it gives our underwriter the ability, the prerogative, almost the responsibility to ask for the home inspection. Trust me when I tell you, you do not want the home inspection in the hands of an underwriter. I don't care if there was very little found. You don't want a home inspection in the hands of an underwriter.
Because they'll look at every word, every page, every picture.
Okay? So keep the references to the home inspection out of the body of the contract. Now, if you want to share the home inspection with the other agent, because they say, oh, well, we didn't know that there was mold, blah, 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 blah. You want to send them the home inspection? Great, do it. But keep it out of the main body of the contract. All right. Make sure your amendment number, sometimes I've seen up to 10 amendments going back and forth. Make sure that they're sequentially numbered. I'm not saying you will ever do this, but there are agents that don't give us all the amendments. Sometimes they write an amendment they don't want the lender to see. Or sometimes an amendment isn't signed. So Amendment 3 wasn't signed, so they went to Amendment 4. So now I've got Amendment 1, 2, and 4. What do I have to do? I've got to ask for number 3. Make sure they're sequential. Okay? Don't, where am I here?
Make sure they're fully executed.
Right, make sure they're fully executed. Don't do amendments late in the game, the day before closing. Now, I know sometimes it's unavoidable. You're doing the walkthrough inspection, right, the day before closing, and the seller didn't do something they were supposed to do. So, and the seller says, I'll give you $500, you know, instead of us having to do whatever we were supposed to do. That's, I mean, we understand. Just make sure you get it to us as quick as we can. We're quick. You can do that the day before closing. We'll get it taken care of. You can still close on time. But other lenders, if you're working with a different lender, they may not be able to do that. Okay? So try to avoid that late in the game. And really, if you're going to do that amendment late in the game, take the $500 and apply it towards the buyer's closing costs. Don't say reduce the purchase price by $500. Any idea why? Any idea why? It's because if you reduce the purchase price, now it changes our loan amount.
Yeah.
But if you just apply it towards the closing costs, it makes it real easy. If you reduce the loan amount, then we've got to do redisclosures, got to go back through underwriting. It's going to be a little bit of a hassle.
And adding closing costs with other lenders, and I can vouch for it, it has to go back to the underwriter, it has to go back to the appraiser, has to be corrected by the appraiser, sent back to the underwriter, and you don't want that. They don't do that here.
Yeah. Structural and safety items will always require a remedy. I told you that roof issues are a big one. If there's stains, what was that? You?
Yeah.
Were showing me. If there's stains on the ceiling, trust me when I tell you it's going to have to be addressed prior to closing. Unless you're doing a renovation loan. How much can the seller pay towards the buyer's closing costs?
5%? No, that's a lot. Is it?
All of it.
You're both right. It depends. Because there's a sliding scale, there's a kind of a matrix type thing. You might want to just jot it down. If your buyer is putting 5% or less down on a conventional loan, then the seller can only pay 3% of the purchase price towards the buyer's closing costs. If they're putting 10% or more down, they can pay 5% of the closing costs. And if it's an FHA loan, no matter how much they're putting down, they can pay 6% of the purchase price towards closing costs. There's one little caveat that usually gets people when they're working with an investor. 2% no matter what they're putting down.
For investors.
For investors. Don't know why. Can't justify it. It's just the way it is. And sometimes there's people that want quick occupancy and the seller hasn't found a house yet. So they say, ooh, can we rent back for 30 days, 60 days, 90 days till we can find our own house? Yes. But the restriction is 60 days. Why is that? And anything over 60 days, we're going to treat it as an investment property. You don't want that. So if it's an owner-occupied situation, the seller can do a lease back for 60 days. Max. Again, not trying to make you guys loan officers. Just want to give you information that'll come up on a day-to-day basis.
Questions that we ask.
Right.
Yeah.
I want you to be as knowledgeable as possible.
Great
So we seem
information.
like we're smart.
Yes, because I didn't know a lot of
That's right. Fake it till you make it.
Yes.
All right. That's it, guys. We're right on the button.
Can I add a huge success story of what he brought up about getting your client in front of a loan officer? A realtor that I worked with kept asking her buddy, you know, let's look into a home. No, I can't. And for months and months he did this. Well, he was a lieutenant colonel in the reserves or army. And she asked me about it. Well, why would he be so standoffish when he's been renting? He makes great money. And I said, well, let me call him. So I left him a couple of messages. And he said, well, I didn't want to tell my buddy that I had a foreclosure on a VA loan. And I said, well, when was it? And send me your certificate of eligibility. I have options for you. He goes, what? Options? So I looked at it. He used a portion. The VA takes away a portion of his eligibility because of his foreclosure. That was in 1993. This was 2015. I told him, I said, what kind of house would you want to get? Well, I'm looking at a John Whelan home that I really liked, and it's $600 and something thousand, blah, blah, blah. And I said, what if I get you in that house with $50,000 down? $54,000. He goes, show me. So he only lost a portion of his entitlement that he didn't know that he qualified up to $379,800 something at 0% down, and then 379, and the difference of 610, he had to put 25% down. He was ecstatic.
So you and the buyers, especially your buyers, they don't know what they don't know. Okay? They have preconceived notions in their head. I don't have enough money. My credit's not good enough. Or I can't find the right home. It doesn't exist in the right neighborhood. We've got solutions for all those things. But they don't know it until they talk to us. Okay? So it's your job to get them in front of us. And then it's our job to gift wrap them and give them back and tell you exactly what they can do, what they can't do. Now, are we going to be able to approve every single borrower? No. No. But we won't just hang up on them and say, geez, you know, you're you're a loser, forget it. Now, we've got other resources and other people, even if we can't help them, we will direct them to somebody that can. Okay? And the bottom line is that makes you look good.
It puts a paycheck in their wallet.
That's right.
Okay?
Maybe a big check.
Thank you
'cause that-
very much,
that
guys.
goes
We're-
for
again, we're here-
$16,000.
Uh-oh.
We're here to partner with you guys. We're part of your team. So let us know what we can do to help.
Thank you.
Can I have the cards?
Yes, send us a copy.
Yeah, anybody that leaves a card, I'll send a copy of this.
Thank you,
I
both.
don't have a card yet, but I think it's.
That'll work.
Thank you.
That'll work. You have one?
Yes, sir. There you go.
No, you give one mine.
All right, thank you.
May I?
And we have all kinds of flyers and printers.
Thank you very much.
It's something I always tell everybody. You're sitting there Friday night at 8:30 working on something, you don't know what you're doing. Call me.
Call Paul, because he's got nothing to do with
I
it.
got nothing to do. Unless my brainchild's there.
Thanks, Randy.
But I still am.
So well.
Yeah. Then you have to do a video check.
Ethan, I can see if you got that.
See that beautiful grandkid. How old is your grandchild?
3 months.
You
Oh,
remember that?
yes, 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 I bet.
I didn't know
chart
that.
that we got
He
from
looks.
last
It's like, get out of the way, kids.
Yes. Uh-oh. Come, give me, give me,
Remember,
give
was
me.
it Bill?
Because then I know I get to go, I just
Had
cry.
a chart for when he said it
The
was-
one that I sent.
Which I know how to settle them down.
Okay, that's what you're asking about?
Wait, did I ask
Here's another one.
Did I ask you about?
I
Yeah,
got some more. Y'all need it. They're good to hand to people. It's good
Okay, may I have
information.
a few?
But double check, I wanted
Just for the weight you read it all.
Thank you.
I just wanted to make sure
Let me check.
that you did it.
I gotta check on my laptop.
That was good.
That was good.
You guys,
Thank
you just
you.
leaving your name tags on the table?
Yes, so she can, Stacy. can-
Yes, I'd rather hold on to it. Just make a pile on the back table.
Okay.
Be fine.
Let's see.
Okay, was this beneficial?